Consumer inflation has slowed more than expected in February. Stats SA data shows annual consumer price inflation was 2.9% in February, down from 3.2% in January. Economists had expected inflation to moderate to 3.1% in the month. Consumer inflation is below the band of the Reserve Bank's target bracket of 3 to 6%, boosting chances of an interest rate cut. The main contributors to the 2.9% annual inflation rate were food and non-alcoholic beverages and housing and utilities. The subdued inflation figures comes ahead of this week's interest rate decision by the Reserve Bank, expected to be kept unchanged. At its January meeting, the Monetary Policy Committee said it expected inflation to average 4% this year. It's expected the upward trend in consumer inflation will likely be driven by higher fuel prices as the international oil market recovers in line with the recovery in the global economy.
That prices increasing at a slower rate implies that prices still increase. Lower inflation rates do not indicate a decline in prices. However, if the Reserve Bank can successfully anchor inflation and inflation expectations at 3%, namely the lower bound of the inflation target range, rather than 4.5%, as they tried over the past few years, they would really use the COVID crisis to the advantage of the South African economy. Sir Winston Churchill famously said, "Never let a good crisis go to waste." And indeed, this COVID-19 crisis is the opportunity for the Reserve Bank to anchor inflation at 3%. Such anchoring of inflation and inflation expectations would create scope for lower interest rates in the future, which would be beneficial to investment and therefore also to job creation in our economy.